Have you ever wondered how that cool breeze from your air conditioning reaches you? Well, behind the comfort of your ACs, washing machines and refrigerators is the complex world of the EMS industry. And within this booming sector is Amber Enterprises, which not only holds 1/4 of the market share in the room air conditioning space, but is also expanding to other areas. In this video, we will break down what Amber Enterprises business does, how it has performed so far, and whether its future prospects make it a right fit for your portfolio. Well, up first is stock performance. Amber Enterprises has seen a strong performance. Its shares have surged over 30% in the past 1 month and around 70% and 130% in the 6-month and 1-year time period respectively. If you compare Amber's performance versus peers, the stock has outperformed Syrma SGS Technology but underperformed players like EPAC Durable and PG Electroplast. Next, let's break down the business. Founded in 1990, Amber's first factory was set up in Punjab's Rajpura. Today, it has 27 manufacturing facilities and is the most backward integrated Indian room air conditioner player. But there's more to Amber than that. The company breaks its business in 3 segments. Historically, around 77% of its revenues have come from the consumer durables segment, while 16% and 7% have come from the electronics and the railway subsystems and mobility segments. Up first is the consumer durables division. In this division, Amber supplies products like heat exchangers, copper tubes, injection moldings, and more. These are not only for the room air conditioning segment but also for other appliances like refrigerators and microwaves. The company has also recently formed a joint venture with Resojet to manufacture washing machines. The second is the electronics divisions. Now this includes printed circuit board assembly and printed circuit boards, vital for consumer electronics, autos, smartwatches, IT and defense. The company is also doing a lot to build its printed circuit boards vertical. It is investing rupees 650 crores over the next 2 years to build a new manufacturing plant. And apart from that, it has also entered into a joint venture with Korea Circuit. The move is expected to help it enter new customer segments like semiconductors. The third segment is the railway subsystems and mobility division, in which the company targets customers in railways, defense, data centers and more. The company's current order book in this division stands over 2,000 crore rupees and would also begin operations at its new plants in Q1 of FY26. So what are the company's growth opportunities? Well, as per Nuvama research, Amber's core consumer durable business is set for healthy growth driven by rising AC penetration. The company's washing machine JV is another focus area that is expected to have a top line of 4,000 to 5,000 crore rupees in the next 5 years. But the big opportunity lies in Amber's transformation into a diversified EMS player. Nuvama projects a 27% CAGR in revenue and a 33% CAGR in EBITDA for its electronic division from FY24 to FY27. The company aims to triple its EMS revenues to 4,000 crore rupees by 2028, which is compared to 2024 levels. So is everything rosy for Amber? No. While Amber has multiple growth factors working in its favor, it is not insulated from risk. First is the higher dependence on room ACs. Amber derived around 68% of its FY24 revenues from the consumer durables segment, mainly from room air conditioners. Thus, any disruption in this segment can impact the firm's earnings. The second risk is the company's growth prospects that could be limited if key customers switch to in-house manufacturing. And third is Amber's business model, which is capex intensive and is exposed to execution delays as well as volatile demand. This can impact the company's returns as well as its cash flows. Next, let's talk about the company's financial performance so far. Amber has delivered a healthy report card in Q2 FY25 with revenues and EBITDA surging 82% and 91% year-on-year. This is driven by growth in the consumer durables and electronics segment. In the first half of this fiscal, consumer durables, electronics and mobility divisions reported revenues of 2,987 crores, 880 crores and 219 crore rupees respectively, with operating margins of 7.1%, 7.7% and 18.9%. Notably, margins in the consumer durable and electronics have steadily improved since FY22. However, the railway subsystems and mobility division faces margin contraction due to revenue delays caused by the Mumbai Metro and Vande Bharat Express projects. If one looks at the last 3 years, Amber's consolidated revenues and EBITDA have grown at a 26% and 33% CAGR, while net profits grew slower at only 9%. EBITDA margin improved from 6.8% in FY22 to 7.5% in FY24. For FY25, analysts expect robust growth, with top line and bottom line projected to increase by 35% and 90% respectively. However, EBITDA growth is expected to remain muted at 3%, with margins only expanding to 7.7%. Coming to valuations, Amber's price to earnings ratio has run up a lot. Current valuations stand around 193 times, and this compares to 92 in FY24 and 39 in FY23. It is also to be noted that these valuations are expected to moderate by FY25 end, but will still remain at 100x. When you compare Amber's valuations to its peers like Syrma SGS Tech, EPAC Durable and PG Electropass, it is at the top with 194, while Syrma is the lowest at 98 times. But it's also key to know that EPAC Durable and PG Electropass current valuations are also in triple digits. So what should you do? Is it a right fit for your portfolio? Well, out of the 27 analysts tracking the stock, 17 suggest a buy, 8 recommend a hold, while 2 suggest a sell. In terms of the 12-month return potential, the average target price indicates a 10.4% downside. And that brings us to end to today's analysis. What are your views on Amber Enterprises, and do you currently hold the stock? Also, which company do you want us to analyze next? Well, let us know in the comments below. Until then, stay tuned to NDTV Profit.